The recent 6 months T-bill auction had a cut-off yield of 3.7% per annum, and I have already subscribed to 30,000 of it and fully allotted. So if you folks remember, some time back I published a video on why I am not subscribing to any T-bills, and the reason back then was that there were better alternatives of high interest accounts and other promotional things that are much better than T-bills, but I highlighted that those are more for cash strategies, right? Because those cash strategies yield a much better return than T-bill. So why did I subscribe to T-bills again this time? I think the main reason that I can attribute is that I am using my CPF ordinary account funds and I'm not using cash for this. So to make it very clear, in order for you to use the CPF OA to subscribe to T-bills, you need to have a minimum of $20,000 in the OA, and anything above the $20,000, then you can use it to subscribe to T-bills. In other words, you're exchanging a 2.5% interest rate from your CPF OA to subscribe to a T-bills of higher interest rates. And for my case, it was 3.7% per annum, so that's quite a good upgrade. But to be really transparent, there is a break-even yield that you have to achieve on T-bills, because whatever there is taken out from your CPF OA, there is an opportunity cost, because the way CPF calculate interest is that they take the lowest balance of the month. And the main difference between CPF OA funding versus cash funding when you're subscribing to T-bills is that for CPF, they will only deduct your CPF balances when the T-bill has been issued, compared to using cash, right? Because cash, they will deduct an upfront payment upon subscription. So for my case, the T-bill auction was only completed on 18th of January, and then my CPF funds were only deducted on the 19th of January. So for those people who are using CPF, at least you can be sure that if you are not allotted to any units, your CPF will still continue to earn that interest on the account and not be forfeited because of the lower balance. Let's take a deeper look onto the T-bill results. So the cutoff yield was 3.7%, and then for competitive bids, 51% will be allotted, and for non-competitive bids, 87% will be allotted. What do those numbers really mean? I'll explain further. So let's say if you apply via a competitive bid, which means you can put in any bid that you want, any yield that you prefer. If your bid was 3.69% and below, you will get a full allotment, 100%, which was what I did. I placed a competitive bid of 3.64%, so I got fully allotted. But what if you place your bid at a cutoff yield of 3.7%? That means that 51% of your funds will be allotted the T-bills. Then the 49% will be refunded. Then for non-competitive bids, it's more like you take the market yield, whatever that is given to you, you will take it. So 87% of your subscription will be allotted. Then the 13% will not be deducted. And if you want a further discussion and explanation about the T-bills, then come and join us at over 13,000 members at the Honey Money SG Telegram group to join like-minded individuals in personal finance. The next question is, how much am I expected to earn from that 3.7% per annum, because it is a 6 months T-bill. So the holding period for a 6-month T-bill will be 182 days, which means that for my case of 3.7% fully allotted, at $30,000 of subscription, there will be 3.7% multiplied by 182 divided by 365 multiplied by $30,000, which equates to around $553. But don't forget, there is a CPF investment fee, which is around $2 plus GST. So the net deduction from my CPF will be $30,000 minus $553 at $2, which will give you $29,449. And my CPF balance went from the previous $52,000 deducted around 29.5k to now $22,000. So the way T-bill works is that they give you an upfront discount during the deduction, and then on the maturity date, they will return the full principal to you, which is $30,000. So for my case, maturity date is on the 23rd of July. That's when they will give me back $30,000 after deducting that $29,449. So now you may be wondering, after this auction, is it still worth it to subscribe to T-bills, especially in 2024? I'll give you some of my personal finance thoughts, which are not financial advice. This video is also not sponsored, so if you want to support my channel, you can click on this interactive brokers link right here and check out what is my preferred broker to buy your stocks and shares. Coming back to this segment, I will answer 2 questions about subscribing to T-bills, as well as 1 question that I will post to the audience. So why did I subscribe quite a huge amount of $30,000 to the current T-bills auction? I think the main reason is that high interest rates may not last forever, especially for the year of 2024. We have seen really high interest rates in late 2022 up till the entire year of 2023. But that was when the US Federal Reserve was very bearish and they were hiking interest rates throughout the entire 2 years to curb inflation. But now that the Fed has turned a little bit more positive, there are no impending interest rate hikes in the near future, which also means that your previous high yield of T-bills, more than 4% per annum, is coming to an end soon. In fact, for the last 12 months, we hardly seen any T-bill cutoff yields above the 4% per annum rate. So this may be the last few opportunity for you to boost your CPF OA funds from 2% to over 3% in order to cover that break-even yield, which was my opportunity because 6 months is not a very long time, it's just a short-term holding period which will mature in late July 2024. So until then, I still have my funds back. The second reason I subscribed to the T-bills this time was because my HDB BTO Key collection date is scheduled to be on the second quarter of 2024, which means it's likely in the May or June period. And during the key collection date, I need to pay my second down payment of 5%, which I can proudly say is much less than the $20,000 in my CPF OA needed. So that 20,000 OA that is capped is more than sufficient to pay that down payment. So it is kind of like a shielding, like I don't want HDB to deduct so much of my CPF, so I put those CPF OA funds into T-bills instead, so I let them deduct whatever is left in my CPF OA. And by the time the T-bills mature in July, they will refund me back $30,000 in whole, which means I will have more than 20k again to do investments or to pay down my mortgage if I wish to. Then the follow-up questions for those of you who are familiar with my channel will be, what will happen to my CPF investments? Because you will need a minimum of 20,000 to invest, especially when I am doing an Endowus portfolio dollar cost average monthly. To be more precise, I'm doing $2,000 monthly into the Endowus portfolio via my CPF OA, $1,000 into a monthly Prime US fund, and then $1,000 into a monthly MSCI index fund. So without that 20k in my CPF OA after that down payment, how am I going to invest? The current plan is assuming that the down payment was paid in June, which means June do not have the CPF OA of 20k. I will then deploy my cash and then pause my CPF OA investments, because without that 20k minimum threshold, you cannot do any form of investments. So during the month of June, I will use my cash to deploy into my investments which were previously investing using the CPF OA. That is one form of alternative that I can think of for now. But I do want to highlight again that whatever I'm doing is for my own personal finance situation. It may not be applicable to you, so don't treat it as financial advice, just treat it as entertainment will do. And therefore, by the time you're watching this video, I don't know what the current T-bill yields will be. Will it be above 3.7%? I can only hope so, but I am definitely not optimistic that T-bills will continue their yield of above 3.7% this year. So what are your thoughts? Are you still going to subscribe to T-bills in the year of 2024? Tell us in the comments down below. And if you want to look at what am I dollar cost averaging, where are my money going into for investments, then I can point you to this video that I did previously for my regular savings plan.